Depreciation is an accounting method used to allocate the cost of a tangible asset over its useful life. It reflects the gradual wear and tear, aging, or obsolescence of an asset. Depreciation ensures that a business's financial statements accurately represent the value of its assets over time, rather than reflecting the original purchase price. Key concepts in depreciation. 1. Assets S. Useful life. The period over which an asset is expected to be useful to the business, typically ranging from a few years to several decades depending on the asset type. 2. Salvage value. The estimated residual value of an asset at the end of its useful life. It's the amount the asset is expected to be worth once it is fully depreciated. 3. Depreciable base. This is the cost of the asset minus its salvage value. This is the amount that will be depreciated over time for depreciation expense. This is the portion of the asset S depreciable base that is allocated as an expense in each accounting period. It reduces the net book value of the asset. Methods of depreciation. There are several ways to calculate depreciation. Each method results in a different amount of depreciation expense each period. 1. Straight line depreciation. This is the simplest and most commonly used method. Depreciation expense is the same amount each year over the asset's useful life. Example: if an asset costs $10,000 with a salvage value of $1,000 and a useful life of 5 years, the annual depreciation would be to declining balance method. This method accelerates depreciation, meaning larger depreciation expenses in the earlier years. A fixed percentage is applied to the asset S book value at the beginning of each year. Common variants include double declining balance, where the depreciation rate is twice that of the straight line method. Formula. Text depreciation expense equals 2 times text, straight line depreciation rate times text, book value at beginning of year. This method leads to higher depreciation costs initially and reduces over time. 3. Sum of the year's digits. This is another form of accelerated depreciation, though it's not as aggressive as declining balance. The sum of the year's digits is used to calculate a fraction for each year, which is then applied to the asset's depreciable base. Formula: text depreciation expense equals FRAC. Text remaining useful life. Text sum of the year's digits times text depreciable base. For example, for a 5-year asset, the sum of the year's digits is 1, 2, plus 3, plus 4, plus 5 equals 15, 4 units of production method. This method ties depreciation directly to the asset's usage or production. It's based on how much the asset is used in a particular period, making it more variable. Formula: text depreciation expense equals FRAC. Text units produced in period text, total estimated units, times. It's commonly used for manufacturing equipment where usage can vary year to year. Why depreciation matters. 1. Financial reporting. Depreciation affects a company's income statement and balance sheet. The depreciation expense reduces taxable income, which can lower tax liabilities. 2. Asset management. Depreciation provides a clearer picture of an asset. S, decreasing value and helps companies track when assets may need replacement. 3. Cash flow consideration. While depreciation reduces profit, it is a non-cash expense, meaning it doesn't directly affect cash flow. However, tax savings from depreciation can improve cash flow, depreciation, and taxation. Depreciation is often used for tax purposes because it allows businesses to deduct the cost of their assets over time, lowering taxable income. Tax depreciation versus book depreciation. Different methods might be used for tax purposes than for financial reporting, as tax regulations might allow more accelerated depreciation than what is recognized under generally accepted accounting principles. Commonly depreciated assets, buildings, and real estate asterisks. These typically have long, useful lives and may be depreciated using straight line or other methods, machinery and equipment asterisks. These assets usually have shorter lifespans and may depreciate more quickly. Vehicles, asterisk. Depreciation on vehicles is commonly calculated using straight line or declining balance methods. Computers and software, asterisk. These tend to have a relatively short, useful life and may depreciate quickly. Conclusion. Depreciation is a crucial accounting concept that helps businesses allocate the cost of tangible assets over their useful lives. It impacts financial statements, tax calculations, and decision-making regarding asset management. Choosing the right depreciation method depends on the asset type, expected usage, and the company's financial strategy.